In this video, we're going to look at social insurance, which is primarily from Chapter 18 of the Rada-McNamara text. We'll start with an introduction to social insurance. We'll look at the basic purposes of social insurance, the major social insurance plans, and characteristics of most social insurance programs. One of the basic purposes of social insurance is to provide loss protection for risks that private insurers are not willing or able to insure. These risks do not meet the ideally insurable characteristics that we talked about. And remember, in our last lecture we discussed how one of insurance commissioners' primary goals is to make sure that insurance is available. Things like retirement and unemployment often are considered fundamental risks, which means they affect a large segment of society at one time. And because they're fundamental, losses could be catastrophic and therefore are not ideally insurable. And so the government steps in and helps to provide insurance on a widespread basis for these types of risks. Additionally, one of the purposes of social insurance is to provide a base of income security, meaning that every American should have a certain amount of income to live on. Now let's look at major social insurance plans. First, OASDHI, which you probably know as Medicare and Social Security, then unemployment insurance, and workers' compensation. There are some other plans which aren't technically social insurance plans, but there is significant government involvement in these plans. We'll look first at government-subsidized insurance and then government assistance. First, the National Flood Insurance Program, which is administered by FEMA. This is government-subsidized insurance, and we'll talk about it here more. And then crop insurance, which is of course for farmers, and it is administered by the USDA, and state and federal health insurance exchanges. One of the significant things that makes all three of these distinct from social insurance plans is that none of them are compulsory or mandatory. Then government assistance. These include Medicaid, state welfare programs, and FEMA disaster assistance programs, which is different from flood insurance or NFIP. The distinct feature of these from social insurance programs is that they're not paid for by the people who participate in them. They're paid for generally by tax dollars. So let's look at the characteristics of most social insurance programs. First, they are compulsory or mandatory. In other words, certain groups, such as employers or workers, have to participate in them. They provide a floor of income, which is related to the purpose of providing a floor of income security for all Americans. Benefits are loosely related to earnings. So in general, the more you put into the program, the more you get out of the program. And benefits are prescribed in the law. So for example, with Social Security, there is a formula for calculating how much an individual's benefit will be. Social adequacy is stressed over social equity. This somewhat conflicts with benefits being related to earnings. As an example, if you pay a significant amount into Social Security and you are considered high income, your benefits when you draw Social Security are going to be a lower percentage of your total contributions than someone who was lower income. There is no needs test for eligibility. This means that anyone, even Warren Buffett and Bill Gates, will be able to collect Social Security when they reach eligibility age. And the program should be financially self-supporting. But this somewhat conflicts with the last characteristic, which is that full funding is not necessary. The point of financially self-supporting is that the program should be paid for by the people who benefit from it. So for example, you pay for Social Security through the FICA tax. However, there are concerns that the FICA tax that has been collected for many years will not be adequate to maintain Social Security. This is because primarily of the aging population of America. The reason full funding is not necessary is that we can always raise the FICA percentages and FICA taxes or limit benefits. However, this is politically highly controversial. Let's look at the specific plans first that are provided by the federal government. Let's look at OASDHI first, which is Old Age Survivors Disability and Hospitalization Insurance. Let's start with OASDI, or Social Security. Social Security consists of old age or retirement benefits which were established in 1935. The beneficiaries to retirement benefits are the worker, a worker's spouse, children under age 18 or disabled children, and a former spouse. Note that someone cannot collect as a spouse and as a worker. Generally, you would choose the benefit that is more generous. Survivors' benefits, which were established in 1939, the beneficiaries are the widow or widower and the children, again under 18 or disabled. And disability insurance, which was established in 1954. The beneficiaries are the worker, the spouse, and the children under 18 or disabled. Next, there's the HI part of OASDHI, which is hospitalization insurance. This is Part A of Medicare. This was added in 1965. Workers and spouses are eligible at age 65 for coverage under Part A of Medicare. Part B of Medicare, known as supplemental insurance, is for outpatient coverage. In other words, visits to your doctor's office on an outpatient basis. Part C is Medigap. It's actually an alternative to A and B. Workers will automatically receive Part A of Medicare if they qualify. In other words, if they've paid in enough to receive Medicare at age 65. But Part B of Medicare is optional, and a worker can choose to take Part C instead of Part A and B, but they have to make that choice. Part C, or Medigap, is sold by private insurers, and there are also many supplemental plans in addition to Part B of Medicare that will supplement Part A and B, or Part C. The point being that oftentimes with any of these, there are shared costs. Most Americans over age 65 find that Medicare itself is not sufficient to cover all of their medical needs. And then there's Part D, which is prescription drug coverage. Now let's look at how OASDHI is funded and how it's taxed when benefits are received. The FICA tax of 2015 is illustrated below. The FICA tax has long been the method of funding Social Security. The FICA tax is 6.2% on the first $118,500 of salary contributed by the employee, and the same is contributed by the employer for all of his or her employees. In other words, this is a match. If a person is self-employed, they must pay both the 6.2 for themselves and as an employer for a total of 12.4%. Note that the $118,500 is what's changed over the years. The 6.2 here and here has not gone up for decades. But for example, in 2014, this was $117,000. So this has been what's gone up over the years. That is the tax base. 1.45% of salary goes to Medicare, and again there is a match. It's 1.45 on the part of the worker and 1.45 on the part of the employer, and that is of course 2.9% total, and that is on an unlimited tax base. Now let's look at how Social Security benefits are taxed, if at all, when received. If your total adjusted gross income when you're retired, or in other words receiving Social Security benefits, is between $25,000 and $34,000, you may have to pay taxes on 50% of Social Security benefits. Or if your income is greater than $34,000 and you're receiving Social Security, you might have to pay taxes on as much as 85% of those Social Security benefits. Note that this is for someone filing single. The numbers are a bit higher for married couples filing joint. Now let's look at the National Flood Insurance Program, which, as I said, is not technically social insurance, but it is a government insurance program. It was established under the Federal Emergency Management Agency in 1968. And in 1983, the Write Your Own, or WIP, was established, which allows participating private insurers and agents to write and service NFIP policies. The Write Your Own significantly increased the participation in NFIP because it became much easier for homeowners to obtain flood insurance coverage. Instead of having to go to FEMA to obtain the coverage, which they can still do today, they can generally go to their own homeowner's insurance agent if they participate in the WIP. Insurers don't bear any of the risk of underwriting NFIP, but they do get 30% for the expenses of servicing the policies. Let's look at some common myths about NFIP, or flood insurance. Some people believe that they don't live in a flood zone, so therefore they cannot get flood insurance. The truth is that everyone lives in a flood zone. Zones have just been established for establishing rate classes. It is the case that if the community you live in does not participate in NFIP, you may not be able to get flood insurance. Being a participating community basically means that you engage in flood mitigation tactics. But very few people live in a community that is not participating. Generally, those are highly rural areas that are not typically affected by flood. The insurance commissioner of Louisiana told me that everywhere in Louisiana is a participating community. Floods only occur in coastal areas where hurricanes and tropical storms hit. The truth is that some of the most damaging flooding occurs inland in states like North Dakota and Tennessee. Flood insurance is very expensive. The reality is that the average cost of flood insurance is $600 per year. The federal government will cover losses from flood. The truth is that FEMA does not provide assistance unless there has been a presidentially declared disaster, and the vast majority of floods do not result in presidentially declared disasters. Now let's look at social insurance programs that are primarily state government programs. Let's start with unemployment insurance. Objectives of unemployment insurance include to provide income to unemployed workers during periods of temporary unemployment, and to help unemployed workers find jobs, and to help stabilize the economy. Characteristics of unemployment insurance include that they are state-funded programs, but they are federally subsidized. Unemployment programs pay 50% of the pre-unemployment wage. States' plans are normally 26 weeks. However, at the height of the recession that started in 2007, Americans could get up to 99 weeks of unemployment pay. This has been reduced since 2013, and unemployment rates have come substantially down. Unemployment insurance is actually paid for by the employer based on payroll, and the higher the employer's turnover, the higher their insurance rate is on unemployment insurance. So this should reduce turnover. Eligibility for unemployment is based on having qualifying wages and employment, so an employee has to have enough in a prior period, usually about the last 12 months or a year. So a part-time employee who made minimum wage might not qualify for unemployment insurance. The idea is that since unemployment insurance is based on payroll, there must have been enough contributions going into the program on your behalf in the prior period in order for you to collect. You must be able and available to work. If you are, for example, disabled, you would be collecting from Social Security. You should be actively seeking work, and you must satisfy a 1-week waiting period before collecting unemployment insurance. And you must not have been disqualified from unemployment benefits because of how you were terminated. If you were fired for misconduct or you quit without cause, for example, you are not eligible for unemployment insurance. Finally, let's look at workers' compensation. Let's start with a look at the history and objectives of workers' compensation. Historically, before the early 1900s, employees had a steep climb in order to prove that the employer was liable to get anything from them for a work-related injury. This is partly because the employer had greater resources and even had certain defenses, such as contributory negligence, which said that if the employee was even 1% negligent, causing the resulting work-related injury, he or she was barred from recovery, or if a fellow employee was even 1% negligent, causing the work-related injury, the employee was barred from recovery. This is the fellow servant rule. And the assumption of risk rule, which is that if you're engaged in a high-risk occupation, such as a railroad worker or coal miner, you may be barred from recovery because presumably your wages are higher for bearing that risk, and you should be saving to pay for any resulting injuries. But workers' compensation replaced all of that. This seemed unfair to most people in society, and so now workers' compensation objectives are to cover most occupational injuries and diseases and to replace lost earnings, and to get employees back to work by providing medical care and rehabilitation. Also, to encourage safety, to provide safe work environments and safe work habits. This is because employers have to provide the workers' compensation. And of course, the higher their rate of loss or work-related injury, the higher their premium. So this does encourage them, or should encourage them, to establish safe work environments and to encourage safe work habits among their employees. Also, workers' compensation is intended to be the exclusive remedy. This is supposed to work because negligence is not a factor, and so the employee does not have to sue the employer. But as a trade-off, the employee cannot obtain pain and suffering or punitive damages from the employer. Their damages are limited to lost wages, medical care, rehabilitation, and survivor's benefits in the event of a death. So this should reduce litigation and should result in lower payments even on the part of the employer. But the employee then doesn't have to prove that the employer was negligent. Whether or not the employer was negligent, any work-related injury should result in the worker's compensation. Now let's talk about laws and options for compliance with workers' compensation laws. First, every state has a type of workers' compensation law. Workers' compensation is compulsory in 49 states today. The only state where it's elective is Texas. So employers have certain options in complying with workers' compensation laws. The most common is to buy insurance from a private insurer, but they might also qualify for self-insurance. They have to prove that they're large enough to self-insure and that they have someone who can administer the self-insurance plan. They can also, in some states, buy insurance from a state-run fund instead of the private insurance industry. And in 4 states, there is no private insurance. In North Dakota, Ohio, Washington, and Wyoming, there is a monopolistic state fund. Now let's look at covered occupations and eligibility. Workers' compensation covers most occupations. Some states do have numerical exemptions for employers, such as fewer than 5 employees. This is not the case in Louisiana. Even if you have 1 part-time employee, you are required to carry workers' compensation. Excluded occupations, though, include farm, domestic, and casual employees, and employees that are covered under a separate act, such as federal employees, railroad workers, and longshoremen. The only requirement for eligibility, then, is that the injury must have been caused by a work-related act or acts and be in a covered occupation. And finally, benefits. First, there's disability, which is often termed indemnity benefits, and there are different kinds of disability benefits. First, these are usually between 66 and 75% of the employee's pre-injury wage. There is permanent total disability, which is the most significant, and then temporary total disability, which means that you are temporarily disabled, but you're not able to work at all. And then permanent partial disability, which means that you are permanently unable to work in the same job or at the same level of wage as you were prior to the injury. For example, if you can no longer use your right arm and you're in construction, you probably can't make as much as you did before the injury. Then there's temporary partial, where for a temporary period of time, you're not able to make as much, but the injury will be eventually resolved. Medical benefits under workers' compensation pay 100%, so there is no cost sharing on the part of the worker. Also, death benefits are paid to survivors. Usually this consists of a lump sum to help with estate clearance or burial cost and other associated death benefits, and a percentage of lost wages. Then rehabilitation benefits, which are now covered in most states. And that's the end of our discussion of social insurance.